Welcome to The Explainer. Today, we're diving straight into the high-stakes, incredibly fast-paced world of commercial real estate finance. If you've ever looked at one of those massive real estate transactions and wondered, how they actually manage to pull the capital together before the ink dries, well, you are definitely in the right place. We're looking at the absolute crucial glue that holds so many of these mega deals together.
It's the exact scenario that literally keeps ambitious sponsors up at night. What happens when you find the perfect asset, the clock is relentlessly ticking, but your deal needs funding yesterday? You've got a hard auction deadline, or maybe a sudden market opportunity pops up, and you just don't have the luxury of time.
Because here is the fundamental problem in commercial real estate finance. There's this massive timeline gap between your urgency to acquire an asset and a permanent lender's ability to actually underwrite it. Conventional senior lenders are fantastic for long-term stabilized assets, for sure, but they simply cannot move fast enough to seize a sudden opportunity. They need stabilized income. They need a long, drawn-out underwriting process, and that creates a critical void in the capital stack that urgently needs to be bridged.
Okay, let's dive into this. Here is our roadmap for today. 1. Bridging the financing gap. 2. When to build a bridge. 3. The almighty exit strategy. 4. Who provides the capital? And finally, 5. Structure and survival.
Part 1. Bridging the financing gap. Function over form. Bridge loans are almost entirely misunderstood by the broader market. People often just write them off as fast money, but a commercial real estate bridge loan is highly strategic. We're talking about short-term capital, usually running 6 to 24 months, whose role in the capital stack is temporal, not positional. What does that actually mean for us? It means a bridge loan isn't a permanent fixture like senior debt. It's a temporary tool. You are literally buying time until the permanent solution is available. And since you're buying time on an asset that usually isn't fully stabilized yet, lenders are conservative. They typically only cover 60 to 75% loan to value, which directly reflects the absence of established, steady income. Now, what's really interesting about this slide is the dangerous cognitive gap between the two sides of the table here. As a borrower, you are probably hyper-focused on speed, right? You want to maximize your leverage and get the lowest possible interest rate. But the lender, they really don't care about your speed in the same way. The lender is focused almost entirely on the ultimate exit strategy. They price the loan based on the uncertainty of their realization, meaning how confident are they that they'll actually get paid back? So if you treat the exit as just a mere formality, you are absolutely going to get terrible terms.
Part 2. When to build a bridge. The 3 scenarios.
So we know what a bridge loan is, but when do you actually utilize this expensive, highly specialized capital? You don't just use it because you can. You use it to solve very specific functional problems. There are 3 main functional drivers that consistently demand a bridge loan. First up, acquisition timing mismatches. You need to close fast to beat an auction deadline before a permanent lender can do their full underwriting. Second, stabilization periods. Say you buy a property that's half empty or needs serious renovations. You use the bridge loan to fix it up, lease it out, and then you secure a traditional loan once the income is actually flowing. And third, refinancing gaps. Your current loan matures, but maybe interest rates are incredibly volatile, or you aren't quite ready to sell yet, so you need a bridge just to survive the gap. Let's ground these concepts in reality. To really visualize how this all works, we're going to look at a concrete, illustrative example. Imagine an ambitious sponsor acquiring a heavily vacant office asset for £10 million. And this brilliantly illustrates exactly how the strategy plays out. Let's follow the step-by-step journey here. The sponsor acquires this £10 million office building at only 60% occupancy. Senior lenders, no way they touch it at that level for a prime rate. So, the sponsor gets an 18-month bridge loan at 65% LTV. Crucially, the interest is rolled up, meaning it's deferred and just added to the loan balance at the end. That frees up the sponsor's cash flow during the repositioning phase. The bridge lender also funds a capital improvement budget to renovate the lobby and the offices. The grand target? Get the building lease up to 90% stabilized occupancy. Because once they hit 90%, the asset suddenly qualifies for a traditional, much cheaper senior refinance, which pays off the bridge lender. The bridge did its job. Section 3. The almighty exit strategy. Underwriting the future. Because to a bridge lender, underwriting isn't just about what the building is worth today, it's entirely about what you promise it will be worth tomorrow. One question dominates underwriting. What is the exit and how credible is it? I really want you to burn this quote into your memory. If you walk into a lender's office with a vague intention of, we'll probably sell it in a year, your loan will be priced exactly like a vague intention, which is to say, expensively. You need specific, evidenced, and totally realistic plans based on the loan's actual timeline. Institutional lenders look way past the headline numbers. First, they're weighing the as-complete value against the as-is value. They want to know exactly how much of their return depends on your grand renovation plan actually working. Second, they look at debt yield instead of just loan-to-value. Why? Because debt yield is immune to capitalization rate assumptions. It's just a much cleaner read if your timeline stretches out. Third, they look heavily at sponsor strength. A marginal deal will literally live or die based purely on the track record and the grit of the sponsor. And notice what isn't a primary focus here: current debt service coverage ratio, or DSCR. Because the asset isn't stabilized yet, current cash flow matters a whole lot less than the actual credibility of your exit plan.
Section 4. Who provides the capital? The lender typology.
So, who actually has the stomach for this kind of underwriting? Well, navigating the private credit market is a major challenge because it is highly fragmented. That means knowing exactly who to pitch is just as important as what you pitch. Up at the top, you have debt funds and private credit. They absolutely dominate the value add phase. If you have a heavy renovation business plan, this is your target. They price off the credibility of your strategy. Next, you have traditional banks. They prefer assets that are already near stabilization. They'll bridge administrative gaps with lower leverage, but they really don't want heavy operational risk. Finally, insurance balance sheets. They actually sit at the refinancing end. They're the ones providing the long-term money that takes out or pays off the bridge loan once all the dust settles. Section 5. Structure and survival when the plan fails. So, the crucial point is, in commercial real estate, the interest rate is the shiny object that borrowers always anchor on. But the legal structure, that determines who actually survives when a plan inevitably hits a snag. You have to negotiate the structure aggressively. Are you paying interest monthly out of pocket, or is it rolled up to the end to protect your liquidity? What are the prepayment terms? If you finish your renovations early and want to refinance, is the lender going to hit you with a massive penalty for not meeting the minimum interest period? What are the recourse and guarantee requirements? Are your personal assets on the line here? And critically, do you have extension flexibility actually written into the contract if your exit gets delayed? Let's move on and see how this builds, because when you hit a delay, the economics aggressively harden against you. At month 0, your 18-month term begins. All is well. But let's say leasing is a little slow. At month 18, you need your first extension. Usually you pay a fee, you accept a slight interest rate step up. It hurts, but you survive. Now imagine you still haven't stabilized by month 24. You go back for a second extension. At this point, the lender knows your plan has failed, their appetite to continue deteriorates fast, and the pricing they offer you to extend, it's going to be deeply punitive. And here is the truly terrifying reality of bridge loans. You can execute your operating plan perfectly and still fail due to market risks. Take cap rate expansion. You hit your 90% occupancy target, but the broader economy shifts, interest rates rise, and cap rates expand. Suddenly, the property is just worth less than you projected, which completely erodes your refinancing proceeds. Or maybe leasing underperforms, which trips a covenant and suddenly brings the lender into your daily operations. Actually, it gets worse. When it's time to refinance, the new senior lender might apply a massive valuation haircut, meaning they won't lend you enough to pay off the original bridge loan. That gap right there is exactly where forced equity injections, meaning you have to scramble to find more of your own cash, or forced distressed sales originate. We've covered the mechanics, the strategies, the lenders, and those catastrophic risks. So I want to leave you with one final provocative thought to challenge your own financing strategies or the deals you analyze. If your exit plan runs behind schedule, are your loan terms actually built to survive it? Bridge loans are an incredibly powerful, totally necessary tool for capturing massive value, but they are unforgiving. Understanding how to structure them is what separates the sponsors who build empires from those who lose their assets to the lender. Thanks so much for joining me on this explainer. Keep learning, stay focused, and I'll catch you on the next deep dive.